Hi, everyone. William Black here, host of the Consumer Credit Matters podcast. Thank you for joining me for this, what is now episode 14 of the podcast series. In this episode, I'm joined by a very special guest, credit risk modeling expert, Dr. Joseph Breeden, where we discuss his latest book, Redesigning Credit Risk Modeling. He's written 6 books in total, and he's got decades of experience in helping companies, lending companies, design credit risk models to help them navigate what can be very treacherous credit environments. In any case, I found the conversation to be fascinating. We go broad and deep on any number of topics that he's covered in his books and throughout his career. I think you're going to find the conversation really interesting if consumer credit risk is your thing. And it probably is if you're tuning into this podcast. So without further ado, I bring to you episode 14, my discussion with Dr. Joseph Breeden. Thank you for tuning in. Bye. Dr. Joseph Breeden, welcome. Welcome to the Consumer Credit Matters podcast.
Thank you.
I've been looking forward to this conversation. You and I have had a couple of, prep conversations, and I think it's worth going into a little bit of how we connected. I think it's kind of a funny story that I saw you, or heard you more correctly, on another podcast, and I said, Dr. Joseph Breeden, that name sounds very familiar to me. It's uncanny. And I went to my bookshelf and pulled off one of the books that you had written. So you are, you're the first author that I've had the privilege of having on the podcast. So at least you've hit that milestone for me. And it was a book that I had read several years ago. In fact, I have it. For anyone watching, I'll put it on the screen here. But it's called Reinventing Retail Lending Analytics. And it was, for me anyway, very insightful and very deep and quite mathy. So much of it, I have to admit, it was over my head in terms of some of the math that you had in there. But a lot of it is, I think, speaks in very fundamental ways about how to approach credit and model credit. And given my background, which was rating, analyzing, assessing, modeling consumer credit in particular, it really spoke my language and allowed me to look at how to analyze credit in a familiar language and yet a different perspective. So I did find it valuable. I think I'm anticipating that this conversation is going to do something similar for listeners who are interested in the topic, who may not have heard consumer credit or consumer credit modeling talked about in the way that you framed it in that book. And I should say that you just came out with another book. Now, you've written, I think, 6 books, if I'm not mistaken, and countless articles on the topic. And you're very busy professional, as I understand it, traveling, speaking, consulting, serving on boards, and so on. I'm sure you can fill in some of this, but you just came out with a new book. Why don't you tell us a little bit of the title and the topic of this new book that you just came out with? I think it was published only a couple of months ago. I've also read that one, the Redesigning Credit Risk.
Exactly. Redesigning Credit Risk Modeling to achieve profit and volatility targets. And so it's too long a title, but that's exactly what it's about. That's why I wrote it.
Nailed it.
So, yeah.
Yeah, well, I read that one too, and that one's much shorter than the other book that I mentioned. And it hits at a higher level, but it still is again framing or reframing consumer credit modeling in a way that I think is fresh. And you're kind of directive in this book. I think it's fair to say. In that you start off, I remember, with something fairly provocative in the book, and you're saying, look, credit modeling has obviously been around for decades, but the way it's being done today, the modeling is like your quote was, it's like putting a jet engine into a Ford Pinto, meaning that we have a lot of compute power, we have a lot of analytical techniques that have allowed more and called more sophisticated data analysis, but we're going about it in the same way that we went about it, regressive analytics, in the same way that we've been doing it for decades now. We haven't really turned into a new chapter of and utilize some of the techniques that you introduce in this book and the other books as well. And I think maybe you can kind of thumbnail sketch the broad strokes of the statement, jet engines and Ford Pintos, I think.
Yeah. So I think of this as my little book of ideas. I self-published because I didn't want a page requirements. Just I wrote what I had to say, and it was in response to a top credit risk executive who said, "Hey, we've done all this machine learning stuff, and it hasn't moved the needle." And in fact, since I started writing this book, I've heard a number of people say, machine learning, it's not really doing much for us. We've kind of backed off. Regression's fine. Well, why would that be? It's such a great technique. I mean, the suite of techniques we call machine learning. So what's wrong there? And when I look at how we do scoring, we're still stuck in this paradigm of trying to make something that rank orders risk. And yet everything we try to do with that score is about knowing what the PD is, fitting that into pricing and yield forecasting. And, if you're running a fintech and you have to sell your loans, nobody wants to know what your score is. They want to know what the yield's going to be. And fundamentally, if you're going to be profitable, it has to come down to yield, internal rate of return, NPV, whatever your metric is. And so what you see is people building fancy scores still with the output of a rank order metric, and then this complicated machinery wrapped around it to try to translate a score into a probability of default. And it's that complicated machinery that's broken, that doesn't really give you a cash flow. It doesn't fit in very well with yield. And so your score winds up requiring a whole lot of fairy dust sprinkled on top to get you anywhere close to what the yields are. And you think, well, scores seem to be doing great, but they're not solving the problem. Mm-hmm. So maybe we need to think again about how we're building those scores so they better connect to the problem we want to solve. Get rid of the complicated machinery between the financial calculations and score.
So score is here, and here we're talking about a proprietary score or bureau scores or any score that would basically, as you put it, ordinally rank the risk. And here I want to be a little bit more clear. You're talking about credit risk, default risk. You mentioned PD, probability default risk. That is too, it's one dimensional, and it's not giving you enough. It's not returning what is most valuable to you if you're in the business of running a company for profit, right? You need to be pricing that risk appropriately. And the techniques that have been used now for decades simply don't take in that kind of that multidimensional information, which we're going to get into, in a way that is taking underwriting to the next level.
That's right. Yeah. Okay. And it's because there are certain fundamental things we're missing when we think about building a score. And the easiest way to say it is that scores don't know when the loss is going to occur. And a loss that happens early in a loan is way more expensive than a loss that happens at the end of a loan. And I've seen people build scores where they try to weight them based on where it happens, or they try to change the window. And again, these are games you're playing around trying to build the same old score instead of just saying, maybe I need to change that. Let's relook at how we're doing this estimation.
Right. And so loss timing, important dimension. I know you mentioned also prepayment speed, another very important dimension to this. Anything else we're missing, or do you want to elaborate on maybe or give an example of why those are so incredibly important to the uninitiated?
Well, I think anybody, in fact, I do training courses, and I was surprised over the last few years that at the end of my training course on credit risk modeling, scoring, vintage analysis, and such, I'll have a section where I talk about, and here's how all this should fit into a cash flow model. And the uproar from credit risk analysts excited to see what a cash flow model looks like. How do you get to yield? What are the key components? And yes, default probability through time, prepayment probability through time. But, depending on the products, what are the purchases, cash advance, balance transfer? Credit cards are nice and complicated. If I'm looking at collateralized loans, auto, mortgage, then I've got the collateral value. And you get these interesting mismatches between collateral value can sag, but the balances are still there. You've got a gap. How do you manage the gap? And so just taking them through this and saying, and then here's your score over here, which traditional score is not really fitting in this framework. So how do we change this? And so I've started teaching my courses backwards now. I start with the view from finance and say, here's a yield forecasting model. They need your input. They need to originate loans. Underwriting needs to be geared toward originating loans that will be profitable. So what do they need to know from you? It's not a score. It's the actual projected cash flow based on defaults and prepayments. And so what does that mean you need to do for them? What is the role of the credit risk analyst? Now, we can get into the how you change that, but that's the directive. How do we change the way the scores are done so they fit the needs of the business better?
As I gathered from your books, there's a framework that is used, the APC, as you refer to it, age period cohort framework. And this is, a very broad way of approaching it. It's not just used in finance, as I understand it. It's also used in a lot of, science, STEM oriented disciplines. But in finance, as we think of it, this was the motivation for, I think, refinement, and what you brought, at least in your book from many years ago now, brought to the world of finance. And I know maybe you break it down a little bit different than APC, but you still have embedded in your your linear algorithm these functions that are at least derivatives of the APC framework. Can you elaborate on that a little bit?
Yeah, it's true. Back around 1995, 1997, I was going to countries in crisis, helping do portfolio forecasting, stress testing, and I encountered. I was a junior analyst, right? And I was specifically given no training so that I would think about the problem from a fresh perspective, which is a challenge when you show up and people want your opinion and you don't know what you're talking about. So I had to learn a lot quickly, and I was introduced to vintage curves, vintage graphs, and of course they called it vintage analysis, but it was really make a graph of different origination pools, compare them, and draw some intuition from it. And I thought, well, if you can intuitively see these things, we ought to be able to write some math down. And looking at that, it's clear that there's a life cycle, loss timing, prepayment timing, that based on how old the loan is, the probability changes. And there are some kind of universal features of what does a mortgage look like, what's a credit card look like. And then in addition to that, you have the economy. Recessions, of course, make peaks, and good times make troughs. And so life cycle, environment, and then credit quality. If you think about it at the account level or a vintage pool level, different groups have different risk level. And so my first formulation was additive. Log odds of default or log odds of prepayment is life cycle plus environment plus credit quality. And it worked, and it worked really well. And so that was that first book I wrote about. And somewhere along the way of writing that, I stumbled across age period cohort models. And I was like, Well, okay, so I didn't invent this. A German psychology professor in 1898 invented this, but I'm happy to borrow it and use it here. Um, but as a conceptual framework, are they really additive? Well, if you segment properly, yeah, statistically speaking, they're nearly perfect. Now, if you don't segment right, I can give you examples where it fails, but there is a way to make that work, and the concept is so easy to work with because if you go back to that cash flow, if finance is trying to project cash flows, well, they need to know the timing. That's the life cycle part. They should worry about future recessions. That's the economic overlay. And they need to do it by your different risk tiers, segments, however you're looking at it. So you've got credit risk overlays. And so in their world, it fits really well. And then the question is bringing that back into a credit scoring world. And there is a connection there too, because survival models have been around for a long time. And so the age period cohort framework is just a specific flavor of survival model that I think works quite well in our industry.
Let me see if I can restate some of what you said to make, and correct me if I'm wrong anywhere along the way. But I found, this is really important. Is a really important concept to dwell on, I think, because I thought it was, one of the best points that your book makes, and that it does connect with what I suspect is very intuitive. Parts of it, anyway, are very intuitive for people who are studying credit for a living. And you're starting off, we should say, with lots of data, time series data. You call it panel data, but just lots and lots of vintage data, right? Which is kind of okay. That's step one, is just getting the data and normalizing that and getting your arms around that, and then you're looking at it, as you said, like I think you call it the maturation function, but in one book, but this age based kind of time frame of the loan behavior. And we'll just, again, for simplicity, we'll just talk about, a couple of little examples here within each of the categories. But age, I think, an auto loan, for example, peak losses are going to be, somewhere in around the 12 to 18 month mark, let's say. Credit cards might be somewhere in that range as well. Just depend. It'll depend on a few things, but that's something that is fairly predictable and observable in the data as you look at more of that. And it's going to be different for different products with different features, even within the same product category. But that's something that you can arrive at. And you're going to develop, as you said, a function around that. So a mathematical kind of a mathematical representation of whatever data pool you have to model, basically. So that's okay. So that's one area that you've, I know I'm simplifying, but that's that's the A in the APC, or the maturation function that in your vernacular. Then you have the quality function. Okay, we're moving on now. And so now you're going to try to separate, okay, well, how do these loans perform if you just look at, again, I'm oversimplifying, but you just look at credit scores, right? Okay, we could say FICO or internal score or whatever. Again, oversimplifying, but what if you just isolate that variable to performance, and what kind of a function can you draw there? And again, it's going to be dependent upon all sorts of things, but the product, you're going to have a certain score, for example, will ascribe to certain performance over time. Okay, so now you've got that, and you want to isolate that variable to other influences like the age, for example. So you can normalize that. And then the last one is, I think you call it exogenous, or you just referred to it as the economic variable, macroeconomic variables. But these are things that are, largely out of your control. But there might be macroeconomic variables like, spike in unemployment rate, or a recession, or a pandemic, or, and it could also be things that you might be in control of, like you could change your credit policy, and that would kind of probably fit into this bucket as well. But here again, you're trying to solve for just those variables and how they impact your credit. Okay, so let me pause there because I want to make sure I got that roughly right. And if you need to tweak that, by all means.
Yeah, yeah, that's right. And the trick is to be able to estimate them in isolation.
Right.
So, if you are trying to compare two accounts in terms of their credit quality, but one of them defaulted at the peak of a recession and the other defaulted at the best times you've had, well, that's not a fair comparison. Somebody who defaults in a recession may not be that bad, just got unlucky.
Right.
Somebody who defaults when unemployment is historically low, it's like, I'm sorry, but what's wrong with you? This is as good as it's ever going to get. And so that's what we want to distinguish on the credit quality. And yes, on the environment, I tend to use very generic language because it can be economics, but it can also be changing collections policies, a new credit line increase decrease program. Things that you do across all of your accounts can put in spikes, maybe a bankruptcy law change or a hurricane. All that stuff will show up in there.
And so, thank you. And as I've laid it out, as you've laid it out, you have the age, which is fairly predictable, and you have the credit quality, which again, on a relative basis, is fairly predictable, like within reason. The one that seems to be the most difficult is the so-called exogenous or macroeconomic. You can't predict the next pandemic. You can't predict even the next recession. Your crystal ball is really bad when it comes to this particular variable. And so you're left with, at least, I imagine if you're running a business, you're left with scenario analysis, as your primary tool for navigating your business, or positioning your business is probably a better way of putting it. You position your business in front of various scenarios that you attach probabilities to, and hopefully you're explaining this to your shareholders and your stakeholders and your board in a way that is like, look, we've built this engine to withstand this kind of a scenario with this kind of probability. And you're updating those probabilities on some, hopefully relatively frequent basis as facts come in on a real-time basis. Is that state-of-the-art thinking around how you model credit risk?
Yeah, you're right that the environment is inherently unpredictable, but it doesn't mean you can't make educated guesses, and certainly you can calibrate to scenarios that you would design. So I wrote an article that was published in I think end of March 2020, because I had friends in China in early January saying something's happening. And it's like, you know what? I lived through remotely, but I was doing work through the Hong Kong SARS recession. And we learned some things from that, and we learned how you can stress test that. And I wrote a paper about that. And that pretty much played out, that the way you want to stress test these things is translate a pandemic, a health disaster into the economic drivers. What does this mean for unemployment and other things? And then, of course, it's very hard to predict what the government's going to do. That's always the unexpected factor, which is a big deal. But you can look at climate risk the same way. We've been doing some really, I would say I'm really proud of our climate risk modeling, because most of the climate risk research is coming out of insurance, and they're worried about whether the building gets knocked down. But if I'm a lender, I want you to have insurance. So it's not the building that worries me. It's that people in your community lost their jobs or had to relocate. And we call it economic contagion. And of course, that turns into an economic scenario, comes back into your environment functions. So you might not connect in your head that this framework applies to all these things, but it does. You can use it. Pandemics, climate risk, you name it. There's a place to plug that in.
I'm glad you brought that up, because the pandemic in particular is something that we'll go back to March of 2020, or maybe just a couple months after that. If you recall, unemployment rate spiked up into the teens. And for those of us who have gone through the great financial crisis, you're back to really your muscle memory is, oh my God. Yeah, I remember the last time the unemployment rate was, in the double digits anyway. And, consumer credit performance tanked very, very rapidly. And it just, losses rose precipitously. It was an awful time, and it was a lot of prolonged hardship for many. Now, you mentioned the government role in our experience here in the U.S. in particular played an outsized role that I don't think anyone could have anticipated. Not only the speed, but also the amount, and also the effect, right? Whose pocketbooks that landed in as quickly as it did. And so I say all of that because I think most people will recall the same kind of surprise who are following credit. But I'd like to understand how you advise and how you kind of think about navigating those waters as a credit modeler, because your models are trained on the past. And yes, you have scenarios about what's going to happen in the future, but here you have something that maybe isn't even in your forecast, because we didn't have the imagination to envision what the government actually did do in this case. So how does one advise companies around those types of events?
Well, the nice thing here, again, if you think about this framework of three pieces, three separable pieces, is that the life cycles still applied. The risk points through that life cycle are still there. Different credit qualities still mattered. There's a difference between super prime and subprime. Mm-hmm. But then if you had built an economic sensitivity model, that model is, inherently unstable to these kinds of situations. And the model predicted high losses because of this huge spike in unemployment and drop in GDP. And yet at the same time, never seen before, forbearance programs, assistance programs, checks in the mail from the government, all these things. So your losses actually went down when your economic model said they should go up.
Right.
And that's where the judgment comes in. That's where you can't just take the model at face value. You have to look at the scenario. But now when you look back, this is really cool that we haven't really talked about the solution to building the credit scores, but what I'm going to advocate, you mentioned panel data. So right. Instead of just marking, did this account default or not, mark, when did it default? So it's like having one row per month per account. Now it's a lot of data, but we've got big servers now. Mm-hmm. And so if you set up that framework, I can say, what was the environment it was living in each of these months? And therefore I'm normalizing that delinquency data or default data so that when I build my score, I'm adjusting for the fact of the conditions the consumer had. And so most people I know who build traditional scores today, looking back through the pandemic, are slicing out the pandemic and say, anomalous period, can't use that. If you put in the environment function, this exogenous function we mentioned, as an adjustment factor, when you're estimating the score, you don't have to throw that data away. It normalizes for those conditions and you still get a reasonable score. So that's the magic of having these three pieces.
Gotcha. I mean, I remember, again, in broad strokes, the reaction from consumer lenders was, first of all, grab as much liquidity as possible. Step one. Mm-hmm. Step two was, stop lending. I mean, exaggerating, but there was definitely a move to, raise scores or it was risk off for sure. So there was tightening initially. I think then the data started coming in pretty quickly that, it wasn't going to be so bad because of all the things that you mentioned, the government, checks in the mail and so on. And we did see a period where lenders then overreacted the other way. It didn't last super long, but there was an over loosening that occurred in 2021, early 2022. Again, I'm speaking broadly here. And then they kind of, and I'm wondering, at least in what I've read and what I can piece together from other studies, is that at least one of the ingredients to that was so-called, credit score inflation, FICO inflation, right?
Yeah.
Where those ordinal rankings got thrown off for whatever reason, they're lagging, their calibration is lagging the real time kind of effects of borrower behavior. And as we mentioned before, maybe that's not one of the variables in this APC framework that's getting updated as frequently as it needs to, or if it is, it's just one of those things that just is really hard to weight correctly when there has been a relatively large recalibration of the root variable, in this case FICO, as in my example. Does that ring true to you?
Yeah. So if you look at the credit quality piece, especially in this post-pandemic period, we've actually seen this before. So we were running vintage models back in 2006, and in early 2006, our models were noticing that the residual risk by vintage, you've got life cycle, you've got your segmentation, but in every segment we looked at, mortgage, auto, credit card, we saw the residual risk rising. And the models started to predict high losses would come according to that life cycle. It's like most people ignore the initial rising losses because they're tiny, but they indicate that the performance is not following the normal track. And then when it matures, it could be quite poor. So our models actually performed quite well through the 2009 financial crisis. And in fact, one of the first large subprime mortgage lenders in 2007, the first one to announce that they had a problem and they were setting aside a $2 billion loss reserve, that was actually our forecast. And that more or less came true relative to what the economy did, which we don't predict. But if you take that education, we did a retroactive study, and it's like in real time, we measured it. Now, with a lag, you have to see the performance. We're not predicting that performance, but that residual risk, we measured quickly, folded back in, and we gave an early warning indicator. So what was it we were picking up on? I did a study with Jose Canal Cerda from the Philly Fed that we published on macroeconomic adverse selection. About half of what we were seeing was poor underwriting at that time. The other half was not that. You could factor that out and say it really was only explainable by looking at change in interest rates, change in property values, and it gets to what I explain as the dichotomy between value shoppers and impulse buyers.
Mm-hmm.
When things get suddenly much more expensive, you shock the value shoppers and they step out of the market and say, I'll wait. Let's see what happens. Now, if you take that learning and go forward to 2021, interest rates start spiking up. And so when I was giving talks in early 2022, I said, we haven't seen the mortgage data yet. We're just starting to get early indications from other products. But based on prior experience, we think these will be bad loans. And in fact, the rate of change was so bad, our models suggested they could be the worst quality loans that have been booked in the last 20 years. Now, the economy wasn't bad. And so losses are the three pieces added together, and both credit quality and economy are variable. So we were making a rather dire prediction on credit quality, but the economy did fine. We're lucky we didn't have a meltdown like we did in 2009. But in fact, what we predicted has pretty much come true. Now, you were talking about score inflation, which is a separate piece. That's not what I was bringing up here.
Mm-hmm.
But if you look at the groups that are most sensitive to the change in interest rates, the change in what you're offering them, it's super prime and prime. These are the ones with the greatest capacity to wait, to defer purchases. And so when they don't like the deal, you lose the good ones in dramatic ways. The subprime group doesn't respond so much to changes in interest rates because they're always just trying to get a loan and there's a cap on the rates, and that's not what drives them. But when they got checks in the mail and it paid off their credit card balances and their FICO scores rose, it didn't actually change who they were financially as far as their financial behavior. So I would say that the score inflation explains the subprime group, whose performance is really quite poor from the last few years. But the change in interest rates explains the prime and super prime groups. And as we track these groups separately through the last 20 years, this is the first time we've seen them all move together like this, but it's coincidentally two different causes, I think.
Let's bring that. That's very helpful. Let's bring that to today, or the last year or so. You see, and let's make it even more narrow, just because I'm personally more familiar with what's happening in autos. I think that the issue is happening not just in autos in terms of consumer credit, but this is where it seems to be most pronounced. I'll call it this divide between prime and non-prime, or prime and subprime borrowers, where today you see, and have seen actually for the last few years, prime borrowers are performing okay, kind of steady as she goes, low losses, weathering whatever the storm may be, in the macro economy. We could have a whole nother conversation about what that is, but we've seen a very different credit behavior, performance, that is, from the subprime cohorts, however you want to split that, usually 660 and below. But those borrowers are and continue to struggle. In fact, delinquencies continue to rise for this cohort. And this is despite, as the unemployment rate being, rock solid and low, and the job environment in general being quite strong and robust over this period of time. And the economy, as measured by GDP anyway, doing very, very well. Now, we know there are negatives that probably affect these cohorts from a macroeconomic perspective that have to do with inflation, and in particular, housing costs, rent basically, and eggs. I guess we can't have a podcast without talking about the price of eggs now. I think what I'd like to understand from your perspective is, what does your modeling tell you about where we are in this part of the cycle today, where we do continue to see this divide that you articulated earlier between prime and non-prime?
Yeah. So it is a situation where there are a lot of things changing at once. That's what makes it hard to assign cause. And most of the time when there are disagreements about cause, it's because everybody's right, and it's a matter of arguing about degree. And so the pieces, I would say, on a relative basis, prime and super prime are just as bad as non-prime on a relative basis, meaning that you look at especially in auto, we see them all moving together. So yeah, I'm not losing so much on the prime and super prime, but I'm certainly on a relative basis losing more than I expect. Now, the bulk of my losses are coming from non-prime, as usual. And in all three groups, it's partly who did I book at the time? And this gets back to that adverse selection. Macroeconomic adverse selection is what we call it. Looking at the conditions, what loan did you offer them? And does that draw in the kind of people you normally expect? And the answer for the last few years has been no. And then you've got the economic environment where inflation across the economy is maybe not the best single measure, because if you look at the non-prime group, the kinds of things they spend their money on is not the same as the prime and super prime. And that group has experienced much higher inflation than what prime and super prime spend, because if you look at food, just the food component the inflation was much more severe than the broader mix that the other groups have experienced. And so, yeah, I think what's happening in inflation has hurt that non-prime group quite a bit. And there's a lot of uncertainty in 2025 about what happens with inflation, and in response to inflation, what could happen to interest rates, and if interest rates spike, what happens with recession down the road. That's the economic side of things that gets back to scenarios, and it's very uncertain right now. As far as who's coming in the door today, so new loans you might book.
Mm-hmm.
Yeah, the Senior Loan Officer Opinion Survey, I pay close attention to the expected volume, because when demand is low, quality is low. It means the group you're losing is always asymmetric. You lose the best ones. And the punchline here is that if on the other side, if you look at tightening and correlate that historically to the residual credit quality, there's almost no correlation. That tightening or loosening, that's your underwriting standards. That's you trying to pick the best of who applies. If no one good applies, it doesn't matter what you choose. So that first order effect is the applicants, and that's what we learned from looking at volume.
So that's a great tip. I hope people heard that loud and clear, looking at the demand part of that survey. And I've certainly been turning my attention to that as well. I look at both of them. I look at both, metrics, but I've been focused more on the demand lately, which I believe is telling a story of you should expect things to get better. Is the kind of my recollection of the direction that the survey shows.
And I'll jump in there because we've seen that before too. That
Mm-hmm.
when I talk about people who a psychologist might call this delayed gratification. Those value shoppers are the ones who can delay a purchase, but only for so long, because cars don't last forever. You might have wanted a new car 2 years ago. You didn't like the price, the interest rate. You're trying to wait, but eventually it's just not working anymore. Those people should be trickling back to the market, which means credit quality should slowly be improving. It would improve really fast if rates came down, but it's going to gradually improve just because demand has to return. There's a certain amount of that in mortgage too. People, their kids start growing up, they need more space, whatever it is. Their lifestyle changes. You can't stay in that house forever, but it's really hard to move when you're sitting on a 3.5% mortgage rate, right? So a slow trickle perhaps, but eventually it comes back.
It's time for the triple bunks, kids. I'm thinking. I do want to dwell on adverse selection. You mentioned this in your book, and you talk about it quite a bit as being. I think you mentioned it being the biggest blind spot in lending, and it brings me back to some many conversations that I've had over the years with lenders when you're entering into what is believed to be a negative credit cycle. And now you're, imagine you are the person in charge of turning the dials of credit appetite, risk appetite rather. And I've heard this debate. I want to know if it rings true to you. Is that you don't generally want to be the first lender to tighten your credit standards, and the reason being is that you're going to almost guarantee this adverse selection. Does that ring true to you?
It depends on how you do it. So, we worked a lot with clients on this. When in a time when we were predicting rising rates means you're not going to like who comes in the door. So what do you do about that? You can't raise rates in response to getting bad quality because you raised rates. That doesn't make anything better.
Right.
So you have to get more segmented. Maybe your segmentation is looking at job security. Maybe it's geographic. And, a lot of it is getting segment specific. Where do I think my yields are going to hold up, even if my credit quality is deteriorating? Ironically, you may have to pull back from super prime. If that credit quality is deteriorating, those margins tend to be so tight, you may not get your yields there any longer, even if overall the losses look low. So it's a very segmented conversation.
So that's a
And
severity question on that in that case.
it can be both because you're still getting higher loss rates on the
Both.
prime and
It
super
could be both.
prime.
You're right. It's both. Yes.
And to your point, prepayment is also a key factor.
Hmm.
If it could be, I don't expect to lose much, but they're taking a high interest rate and I know they're going to prepay the second they get a chance. So they're not going to be sticky. I don't get the long tail for my yield. It may just not work very well. So you have to be really careful about the yield forecasts in those dynamic situations.
Gotcha. That's helpful. Thank you. Okay. I want to go back to a word in the title of your book that we haven't talked about yet. But you did talk about quite a bit in your book. So the name of the latest book, Redesigning Credit Risk Modeling to Achieve Profit and Volatility Targets. Now that's interesting.
Yeah.
So here we are. Profit we've covered, I think, that you need to look at your lending book holistically because you're trying to earn a profit. So why wouldn't you look at your lending decisions based on that metric at the end of the day? But maybe you can explain why volatility, how and why volatility enters into this decision making in this framework that we've described.
Um, I think it's especially important when you think about machine learning. And my thesis work was some time ago, numerical methods in chaotic systems. So quantifying chaotic systems and predicting chaotic systems. And I was working with a small team, and one of the people on the team in a meeting said, so we're really talking about there are pockets of predictability, and then there are these other regions where you don't really know what's going to happen. And forecasting a highly nonlinear system, whether it's truly chaotic or not, is about finding the little pockets of predictability and then understanding that the rest of it's not predictable. This has always been true, but in a regression model, things are much more uniform. If you actually measure your forecast uncertainty, it kind of smoothly changes. And this again goes back to that 1960s framework where
Mm-hmm.
we're used to saying that uncertainty is a constant, so we ignore that. And I've yet to see an underwriting system that focuses on uncertainty, except for thin file, thick file. Everybody understands that. If I get a bureau score, but there was very little data, I don't trust it so much, I'm going to give them a starter product.
Mm-hmm.
So we do already consider this. We know about it, but only in this kind of case. And we don't look to the model to tell us. We're doing this as a business overlay. But with machine learning, highly nonlinear models will have highly nonlinear uncertainty. And so I think one of the biggest failings in how we use machine learning models is we should not just be asking what's your forecast, but what's your uncertainty in your forecast. And at the point of underwriting, you really need to think about a second dimension in your decisions. I have my forecast, PDs or prepayment, and then I have the uncertainty in that forecast. And so if I have a high default rate and high certainty, I know I don't want it. If I have a low default rate, but still high uncertainty, well, that's more like the starter product, right? And so I need to consider these dimensions as I'm designing the product, pricing the product, and we can't ignore it anymore. And I think let's just say this could be one of the reasons people don't see the lift from machine learning that they expect because they're not considering the uncertainty in those forecasts.
Right. I mean, at the end of the day, this approach doesn't break that kind of fundamental risk reward dynamic.
There's been discussion of risk reward trade offs in lending for decades, but somehow that discussion got somewhat distorted because you see a lot of things where they talk about reward being yield and risk being losses.
Mm.
Losses are not your risk. If you can predict them, they're an expense. It's the uncertainty in loss and revenue that is your risk. And so if I was coming from an investment bank, coming from a trading background, uh, they would know this immediately. That is in that market. You look at expected return over volatility and return. Nobody would look at only their losses. And
Well,
so
losses are a function of yield or a subcomponent of yield there.
that's
So
right.
you've
And
already
so what we need to do here is to say, here's my predicted yield, here's my predicted uncertainty.
mm-hmm.
Every segment, every product is some point in this matrix, this view of the world. And that this is where you get into modern portfolio theory. How do I get the optimal blend of these things? And the reason modern portfolio theory hasn't worked very well in lending is that they've used the wrong inputs. The basic theory of combining things isn't that broken, except I say that, but actually I have a chapter in the book explaining what's wrong with modern portfolio theory, and it's the life cycles. It's the problem that you have to look multiple years in the future. You can't just look at next quarter's yield, next quarter's volatility, and that doesn't really fit in with that theory that's based more on traded instruments with no long-term predictability. So short answer is you can solve this problem with simulation, where you set a target. Here's the ratio of return to volatility or whatever your metric is, and then you can run simulations using that APC framework and optimize your originations and your strategy along the way to try to hit those targets. And it actually works fairly well.
Okay. Well, let's move along. I think one of the things that I wanted to talk to you about that's in your latest book has to do with the use of AI. We've already talked a little bit about machine learning, but how do you see?
Yeah, it's a rich topic to discuss. I would say that AI, the popular way to define AI today is large language models, generative AI. It is being used for communication with consumers. When I put on my hat of, I volunteer as president of Model Risk Managers International Association, MRMIA. There we think about how do you verify, how do you monitor all these things. Large language models are incredibly difficult to apply model risk management principles to successfully. Everyone says the standard guidelines apply, but how do you check the data that went into it? How do you, there's so much testing and control we do on our credit scores that you can't possibly do on a large language model. And so that's why I think they won't be included for a while in underwriting decisions, but it's safer to use them in communications and other areas.
Mm-hmm.
Now, I step back and say, I don't look at large language models for decisioning in our space. And I think this is where the hype comes in. I think people try to use them for too much. They only know what they've been trained on, which is primarily language, or at least tokens. But in our industry, we put so much effort into models based on data, the limited data, proprietary data. A large language model can't look at your book and give you strategy because it doesn't know any of the dynamics that we've talked about through all the way up through this podcast. So I think the best way to think about a large language model is as an executive function. If you look at cognitive neuroscience and studies into artificial general intelligence, I like the paradigm of thinking about your conscious mind being this executive function routing problems. And some problems get routed subconsciously before you ever think about them. Everything we do in our lives, there's a whole set of subconscious functions going on. But the models we build are almost like the subconscious functions of our brain, and the large language model can be the conscious routing, saying, I have this kind of a problem, I need an answer from you, and call the API. And so it may be that a large language model communicating with executives or with consumers identifies the problem and says, okay, this API should know that answer, let it compute, bring back the answer, and then you communicate that out to the stakeholder. And so that's that's where I see this going, is that all the other work we've been doing doesn't go away. It certainly will not be improved by large language models, but they become a set of APIs. And this becomes the connection between all those.
So you mentioned in your book, I think it's one of the closing chapters that I forgot what you call it, a strategic agent, or this. It kind of hits on the agentification of a use case for AI, which is what you've described. But I guess I'm still trying to imagine, like, maybe you can just by example provide an example. Like I'm an executive and I have a lot of models and data, access to a lot of models and data, and I'm having difficulty making a decision around how to steer risk appetite. That the model isn't model's giving me scenarios, it's not telling me what to do, but I'd like to get another opinion, and so I ask the agent. Is that the use case that you're describing?
That is right along those lines.
Yeah.
What inspired me was actually AlphaGo. Um, you know, seeing that algorithm teach itself how to play Go through simulation and then go up against humans with novel strategies that the humans hadn't come up with before is pretty inspiring as far as what AI could do for us. Um, and so in our context, all of the modeling we've been doing and the optimization that we can do, this is like the rules of the game. And then if you have the kind of generative AI, which is communicating with the executive. So the executive says, hey, my economist just said there's going to be a recession in 18 months, or at least there's a decent chance of it. What do I do about that? And he might know standard answers, or he might have his own intuition but want a second opinion. And so he says to our strategic recommendation agent, give me some strategies if there's going to be this kind of recession in 18 months, and give it the scenario. And then it says, okay, let me structure a bunch of simulations I can run to see what the optimal strategy would be. And it calls a set of APIs, which is really all of our forecasting algorithms and the optimizations. And those come back and say, well, given that economic scenario, your current portfolio, here's the optimal origination strategy over the next 2 years. That information goes back to the generative AI, and it brings it back in English and via conversation with the executive. So that's the role I see for an agentic AI, is really gluing together all the work of the data scientists with the executives to come up with better strategy.
I was at a conference about 10 years ago. It was a Lend It conference here in New York, where people were up on the dais, and they were proudly talking about, from fintech, XYZ, talking about how they were getting, lift in their credit decision models by using all this alternative data. And I can't remember exactly what the anecdote was, but it was something along the lines of, well, we can tell, exactly how the applicant is navigating their web browser, and that is or can be predictive in terms of how risky a borrower they will be. Okay.
Mm-hmm.
And that was very interesting to me. And they were, showing data that would, lend evidence to the lift in those presentations. And the next year I went back to the same conference, and nobody was saying that. And my guess is that the lawyers probably said, "Hey, you might not want to do that. You might be violating some kind of consumer protection laws in so doing, or disparate impact or whatever." I mean, there are regulatory and legal prohibitions for good reason that exist in this country. So that is one that might be one reason why we're going to be using the same data sets that we have, that we can avail ourselves today, even going forward. Even though we know there is value in this data, you're just going to be constrained from using it because there are other considerations around access to my private information, or people's private information that we just as a society say, no, you're not allowed to do that. Other countries might be even more restrictive. We know Europe is. Other countries might be less restrictive. And I think the example you give in your book is an example in China, if I'm not mistaken.
Which is very unrestrictive in this regard. Exactly.
Unrestrictive in this regard, correct. Right.
Yeah.
They're lender friendly, I guess you might say.
Yeah, so there's a lot of great context there. And if I can try to tie some of our conversation together on this point, that when I was looking at adverse selection, this residual risk, there's a temptation to think that that's just random noise in the process, but it's not. It's highly correlated through time. And the magnitude of this residual risk is comparable to the amount of structure you can explain with your score. And so what that means to me is that scores can be very good at rank ordering with the data they have, but there's another dimension that they don't see at all. Consumer behavior, psychology, whatever it is. It's not bureau data. And if you had both of these, your predictive power would be twice what it is today. Mm-hmm. In aggregate, I can measure adverse selection. I can hypothesize that it relates to whether someone is a value shopper, but there is this other dimension that I'm never going to get to on an individual basis without some kind of alternate data. Now, is it fair for me to look? I'm certain it has to do with the kind of data, the source of the data, whether that data correlates to a protected class status. You know, your example of clicking on a screen. My mother, maybe elderly people, not very efficient in clicking in their web browser, right, as opposed to someone young. So if you wind up correlating to age, not going to come out well. And so is there data we can use that's considered fair, which also gives me a better idea of just what someone's credit risk or prepayment risk is, so that I can properly design or price the product. And a lot of the alternate data, I do need some kind of nonlinear modeling attached to. I wouldn't stick a large language model on there, but machine learning algorithms I would use as a way of pre-processing that data. And my caveat there is, again, back to model risk management. I can't tell exactly what the large language model is doing, but I can validate any nonlinear machine learning model one way or another. And so that's the connection I see through all those things. And as far as what kind of alternate data you can use, the main winning alternative right now is not so alternate, but people are looking at deposit accounts to understand cash flow with permission.
Right.
So they can say for this individual, so not the product cash flow I've been talking about, but the consumer cash flow, are you growing your assets? Are you shrinking your assets? Does it look like you've lost your job? Is your compensation steady or variable like an Uber driver? That can just tell me what kind of product you need. If you have variable income, but overall it's reliable, I need to give you something that helps you get through the low spots. That's a good product to offer. So there's a way to look at that as helping the consumer, and it is a kind of alternate data. It's not quite as cool as the folks who are using cell phone information to offer you a loan. And I've seen talks from Central Africa where they stick a device up to your phone and they look at who your friends are and what your apps are. And it's like, no, we're not going to be doing that here.
Right. Can you make a credit decision based on your forecast of prepayment likelihood?
This is a point of discussion. And so when you're modeling prepayment rates, all the methods apply that we've been talking about. Mm-hmm. But if I have an individual assessment of your prepayment rate and say, therefore, it won't be profitable for me, therefore, I'm not going to offer this loan to you, and I have to give you a reason for rejecting you, and I say it's because I don't trust that you're going to keep this loan, my analysis says you're going to refi in the next 6 months, that may not make a regulator happy. I can say may not because it's, I suppose, largely untested, but I know some legal teams don't like that. So instead of trying to make an account level decision based on your prepayment rates, we can step back and say, here's a large segment that I have, which generally does have higher prepayment rates, and therefore I'm designing the product that gets offered to the market this way with this pricing. And I'm not making it a decision based on you. I'm just saying, as one of the quadrants or, however many segments I've got of my portfolio, this is the product I'm offering today.
Right.
That's more likely to be acceptable to a regulator. But it
Yeah.
is still a profit-based approach, as you said. Yeah.
All right. I have a question. I guess a closing question is: have we missed anything? Anything that we didn't, that I didn't ask you about, or that you wanted to talk about, that was in either in your most recent book or in your writings?
There's one stone that the flow of our conversation went around, and I guess I'd like to turn over the stone, which is that I talked about changing how we build our score to a panel-based approach. And what I mean when I say that is that at the time you build the score, you bring in the life cycle and the environment. So you tell the score to focus on the residual risk. And one of my rather surprising discoveries is that when you do this with machine learning, which you can, the same approach, panel-based modeling, I have not seen hardly anyone build panel-based machine learning models. But if you do, and you do it this way, all this discussion we see around rapid degradation of machine learning models out of time because of overfitting, it goes away. When we've built machine learning models this way, they last for years. We're not getting that rapid degradation. And I think what it means is that our mental model of what overfitting is in our industry is wrong, because we don't have thousands of different inputs. We've got a few bureau fields and a few application fields. We're not massively overfitting through a vast space. What we're really doing is misallocating the structure. What is really due to the economy or due to the age of the loan gets misassigned, misattributed to individual consumer attributes. And so when you build a panel machine learning model, it allows the model to clarify that structure and be robust out of time. And we only discovered this because we were trying to make machine learning cash flow models. We did it just because we wanted it to fit into a yield forecasting. And so with this approach, your machine learning model directly connects to what the yield's going to be, which is great, but it actually is more accurate at doing that as well. So that's a technical point that only a certain part of your audience will care about. But when it comes to machine learning, I feel like that is a massively missed point in our industry, is that we're not building them right because we've got this confusion between variables at the time of estimation.
So let me try to make sure that I understand it. Maybe this is a question on listeners' minds as well. Just I want to make sure I understand this point that you just made. So we and again, I'm going to try to. I'm sure I'm going to oversimplify, but just to try to make sure I get the gist of what you said, because we talked earlier about what's called the three functions, in the APC approach. And each of those functions, if you go down the rabbit hole, I'm sure it can become perhaps infinitely complex in terms of the techniques you can use to mine more and greater value out of whatever data sets you have. And then, as a part of updating that algorithm that's bringing back, a useful dimension to your credit decisioning, whether it's yield or whatever, profit, ultimately, is going to need to be updated as new data comes in. And those functions basically need to be updated as new data comes in. And is what you're saying is that where machine learning can be particularly helpful is in the update and refinement of those algorithms, those lanes of algorithms that I just described, so that your error quotient in your algorithm is minimized, or am I missing it? I have a feeling I'm missing it, but I would like you to clarify, because I'm still not sure if is it that the machine learning is able to do things that is just inhumanly possible because of the vast amount of data and calculations that would need to update these functions on a real-time basis.
Yeah, so if you take a training data set that you would normally have given to a logistic regression to build a score, and you give that same data set to the machine learning algorithm, it has more flexibility to explain all the nuances in that data. And we would call that overfitting normally. But what we're finding is that it's not fitting to noise, it's fitting to structure that doesn't have anything to do with the consumer.
Got it.
It's what the score is trying to explain is also the economy and the life cycle, but it doesn't know it's the economy, so it doesn't use scenarios in the future for the economy. So it's a conflation of these different effects. And in fact, when you build that machine learning score, if instead you use this panel approach where you say, I know the life cycle already, here it is. I know the environment already, here it is. Now use scoring factors to explain the things that we don't know yet. And that's when it gets so much better.
Right. So what we would call overfitting is something that we couldn't explain, but machine learning techniques would, in another way of saying it, maybe I think it sounds like it's almost like a false positive, right? Is how I think of it. And so, but the machine learning is actually able to divine true value from what we mere mortals would have called noise or overfitting, which is, I guess, is kind of hard to identify, I'm guessing.
It can do that if we focus its attention. And so basically what we're saying is, don't try to explain everything. Try to explain this piece and let the rest of the framework handle the other pieces. And that's when it gets good.
I see. Okay. So basically you're creating so we talked about 3 functions. Now I'm again oversimplifying. Now you got a 4th function that the machine learning machine learning focus is tuned in on, and it's creating another function of value.
Well, it's the 3rd credit risk function, just doing it better. Because the way people use machine learning today is they give it the whole data set and tell it to explain everything.
I see.
And so it's trying to do all 3 pieces. And we're saying, just give me the credit risk piece, because I already know the others. And that's when it works better.
Okay. Good. Great. Well, I'm glad you made that point. Thank you. And this has been a great conversation. So I hope people enjoy it as much as I did. And I would, I'll put the names of the books that you've written. Although I don't know if they're all still in print, some of them, but certainly the ones that are still in print we'll put on the show notes, as they call them. And we should also mention that you have an active website for the wine lovers in the audience. I think that might be of interest, using some of these same analytical techniques to to forecast auction prices for wine collectors out there, right?
Yeah, I've been actually doing that for as long as I've been running Deep Future Analytics. So
you should have done the podcast from your wine cellar. That would have been way more interesting.
Yeah. Auctionforecast.com if you want some wine data and forecasts. But the books are still out there. I was going to tell you my favorite story. You held up your book. I went into an office one time. I was invited to come talk to a group, and somebody who met me and didn't know I was coming said, "Oh, I have your book." And he pulled it off the shelf, and it was the rattiest, most worn, shredded copy of the book I've ever seen. And I love that.
Yeah, that is awesome. It's been read, and there's a lot of depth in certainly in this book in particular, the Reinventing one. And I think the book I have has actually been updated. So again, I'll put all that in the show notes. But it's very meaty for sure, and one that I will and have already gone back to several times. So. Thank you very much, Joe. It's been a real pleasure speaking to you. You've been very generous with your time and patient with me as you walk me through some of these complex topics. So really appreciate that, but it's been a real education, and thank you very much. Best of luck to you.
Thank you.
Take care.
Care.